Imagine opening your banking app on payday. Your savings earn 0.9%, yet a banner advertises 5% Treasury bills. Stocks whipsaw, inflation nibbles at cash, crypto feels like roulette. So, where does ordinary money grow safely? Bonds hold the answer, but words like coupon, par value, and duration push many people away. In the next 10 minutes, BytePlain will translate those terms into plain English, show why 2025's higher yields make fixed income relevant again, and pinpoint which maturities match real-life goals. By the end, you'll know exactly where bonds belong in your portfolio. So what is a bond? A bond is simply a loan you extend to a government, corporation, or municipality. In return, the issuer makes two contractual promises. First, it will repay the principal, called the face or par value, on a specified maturity date. Second, it will deliver periodic interest payments, known as coupons, throughout the life of the loan. For example, purchasing a $1,000 Treasury note with a 5% annual coupon and a 10-year term entitles you to $50 in interest every year, usually split into two $25 installments, and the full $1,000 back at maturity. These predictable cash flows give bonds their label as fixed income securities. Three factors govern every bond: the issuer, who owes you; the coupon rate, what they pay you; and the maturity, how long the loan lasts. Alter any of these variables, and the bond's risk level, market price, and expected return adjust accordingly. Who issues bonds? Think of issuers as rungs on a credit ladder, each step trading higher yield for higher risk. U.S. Treasuries, top rung, backed by the federal government's taxing power. Their default risk is considered negligible, so yields sit at the floor of the market. Investment-grade corporates, well-capitalized companies, think Apple or Procter & Gamble, pay a modest premium over treasuries to compensate for business risk, yet still carry solid A or BBB ratings. High-yield, junk bonds. Smaller firms or highly leveraged issuers must offer noticeably higher coupons to attract buyers because credit agencies rate them below BBB. Missed earnings or recession fears can widen these spreads quickly. Municipal bonds. Issued by cities, states, or special districts, interest is often exempt from federal and sometimes state income tax, making their after-tax yield attractive, though credit quality varies with local budgets. The farther you climb for yield, the thinner the margin for error, so balanced portfolios mix several rungs rather than standing on the highest step alone. Price versus yield. Here's where many investors pause. In the bond market, price and yield move inversely. Visualize a balanced seesaw, price on one side, yield on the other. When prevailing interest rates rise, new bonds offer higher coupons, so an older 3% note becomes less attractive. Buyers insist on a discount, pushing its price down until the yield aligns with current offerings. Conversely, when rates fall, that same 3% coupon exceeds new issue yields. Demand bids the price upward, and the effective yield declines. The pace and magnitude of this adjustment are captured by duration, a measure expressed in years, showing the approximate percentage change in price for a 1 percentage point move in rates. Longer maturities and lower coupons create higher duration, causing greater sensitivity and larger price swings, while short-term Treasury bills sit almost flat on the seesaw. Grasping this relationship is essential before selecting any fixed income investment. How bonds generate returns? Returns are generated through two linked channels: steady income and potential price appreciation. Total return equals two components: coupon income and price movement. Coupons are the contractually fixed cash flows. They form the baseline return when interest rates remain steady. The second component, price change, reflects how the bond's market value adjusts to new yield conditions. When prevailing rates decline, older bonds with higher coupons become more attractive, and their prices rise. When rates increase, prices fall. Consider a $1,000 corporate bond with a 5% annual coupon. The issuer pays $25 every 6 months, delivering $50 per year regardless of market shifts. If yields fall and investors bid the bond up to $1,050, selling at that point realizes a $50 capital gain, in addition to the coupons already collected. If yields rise and the price drops to $950, the investor records an unrealized loss, but still receives the scheduled interest. And, assuming no default, will collect the full $1,000 at maturity. Recognizing how these two streams interact is essential for setting realistic performance expectations and managing risk in any fixed income portfolio. Bond ratings. Agencies such as Moody's, Standard & Poor's, and Fitch convert complex financial statements into letter grades that signal default risk at a glance. The scale runs from AAA, exceptionally strong capacity to pay, down through AA, A, BBB, collectively investment grade, then on to BB, B, CCC, CCC, C, and finally D for default. AAA/AA issues, mostly sovereigns and top-tier corporations, have vanishingly low historical loss rates. A/BB still meet pension and insurance mandates, but can be downgraded in severe recessions. Anything BBB or lower is classified as high yield and must offer larger coupons to offset the higher probability of missed payments. A single-notch downgrade, such as BB to BB, can trigger forced selling by index funds, causing price drops and sudden yield spikes. Ratings are not fail-safe, yet they remain the essential first screen for assessing credit quality before analyzing individual balance sheet details. Why investors hold bond. 1. Steady income. Regular coupon payments arrive on a fixed schedule, monthly, quarterly, or semi-annually, creating a predictable cash flow stream that can fund living expenses or be reinvested for additional growth. 2. Volatility buffer. High-quality bonds historically move less than equities and often gain value when stock markets contract, reducing overall portfolio swings and helping investors stay disciplined during downturns. 3. Capital preservation. Investment-grade bonds, and especially U.S. Treasuries, have extremely low default rates. Their return of principal acts as an anchor in diversified portfolios, safeguarding money earmarked for near-term goals. 4. Deflation hedge. In economic slowdowns, central banks cut interest rates. Falling yields push existing bond prices higher, offsetting declines elsewhere, and providing purchasing power protection when consumer prices stagnate or drop. These characteristics explain why the long-standing 60-40 model, 60% equities for growth, 40% bonds for stability, remains a common benchmark. When equities experience sharp drawdowns, investment-grade bonds have frequently cushioned losses, buying investors time to rebalance rather than sell at market lows. Risks you can't ignore. Interest rate risk. When market yields rise, the prices of existing bonds fall, and the effect is magnified for long-duration issues, those with lower coupons or distant maturities. A 1 percentage point rate jump can trim 8% or more from a 10-year Treasury's market value. Credit risk. If the issuer's finances deteriorate and it defaults, coupon payments stop and investors may recover only a fraction of principal after lengthy restructuring. Even a downgrade can widen spreads and depress price. Reinvestment risk. Coupons in maturing principal may have to be reinvested at lower rates than the bond originally paid, reducing overall income, especially problematic in declining rate environments for laddered portfolios. Inflation risk. Rising consumer prices erode the purchasing power of fixed coupon payments. A nominal 5% yield delivers negative real return if inflation accelerates to 6%. Mitigate these threats by staggering maturities, laddering, holding a mix of government, corporate, and municipal issuers, and allocating a portion to Treasury inflation-protected securities, TIPS, or shorter-term instruments that reset more quickly to new rate conditions. Are bonds back in 2025? After more than a decade of near-zero yields, the 2025 rate landscape finally rewards savers with positive real income. 1-year Treasury bill, 5.2%, a government-backed return that eclipses most high-yield savings accounts. Investment-grade corporates, 5.8% on 5 to 7-year A and BBB bonds, offering extra spread for modest credit risk. High-yield index, 8.5, equity-like cash flow, but with elevated default probability. To judge these figures in real terms, Subtract the current 12-month inflation rate, about 3.4, and you obtain inflation-adjusted yields of roughly 1.8 on Treasuries, 2.4 on quality corporates, and over 5 on speculative-grade debt. This is the first time since 2007 that short-duration Treasuries deliver more than a full percentage point above inflation. For conservative investors, bonds are no longer dead money. They once again provide a viable combination of safety and real return, as long as duration remains aligned with personal time horizons. Let's recap. Bonds are simply loans to governments or companies. Their prices fall when yields rise, and duration measures that sensitivity. Credit ratings flag default risk, and 2025's higher yields make bonds a meaningful source of real income again. If this overview clarified fixed income, tap like so others can find it, and leave a comment with your bond questions. I read and reply to all posts. For more money guides, subscribe to BytePlain. Until next time, keep your money working even while you sleep. Thanks for watching and sharing this with friends.
This video is for educational purposes only and isn't financial advice. Always do your own research or consult a licensed professional before making money decisions.